Debt funds are going through a rough patch. And to take care of the underlying issues, SEBI has come out with certain norms to take care of them. What are these norms that SEBI has come out with? How will they impact the investors? All these things will be discussed in today's Investors Hangout, brought to you by Aditya Birla Sun Life Mutual Fund and Value Research. With me is the CEO of Value Research, Dhirendra Kumar. Dhirendra, we welcome you.
Thank you.
As I said, there are key changes that SEBI has brought out. What are these key changes?
3-4 critical things. One is that, liquid funds, which account for nearly 20% of the total mutual fund industry. It is being used as a bank account, short-term parking, money for a few days, money for a few months, few weeks is put there. And that has become very sizable. And liquid funds are not, really liquid, in the sense that investors use it like a liquid fund, but if the underlying is not liquid, so SEBI has gone about addressing that very meaningfully. Now, 20% of all liquid fund money must be in government securities, repos, and which are actually liquid. It can be realized. So if 20% of investors, 20% of the money in a liquid fund turns up to be taken out, or investors turn up to take their money out, it can be done without any disruption, without much of a problem. Then the second thing is, provision of a staggered exit load for 7 days, which means that, it is basically setting the expectation right, that investors who invest in liquid fund should have few days, time frame, at least a week's time frame in mind. Third is that, all debt securities will be marked to market. What was happening so far is that liquid funds were very tightly regulated. They were supposed to invest in securities of only maturing within 60 days. But that apart, the valuation matrix being followed was such that even if the underlying investments are moving up and down a little bit, of course, these funds or the underlying securities or these bonds, they are not as volatile as equity or anything like that. But even nominal volatility, investors were not experiencing it because the valuation matrix made it artificially very smooth. So it looked like a nice smooth line. It always went up, and that is not the reality. So making the whole portfolio to be marked to market based on the realizable value of the underlying securities. So it will become a little more volatile. The net result of all this will be that two critical things. One is that liquid funds will become a little more volatile. Investors will look at liquid funds for a period of less than 7 days. They will have to look for other alternatives. And SEBI has enabled such alternatives. There is another category which is, overnight fund. If you want to invest for any period of less than 7 days, go there. So you will be taken care of. There won't be any exit load, and the underlying will be pretty secure. You will not get surprises. So it is actually, setting the expectation right, matching the underlying investment and investors' experience very much aligned. It makes liquid funds very safe, much safer. And the scale of this had turned out to be of a kind which could have posed a systemic risk if a lot of investors turned up to take their money out one day.
Okay, as you mentioned, the overnight funds may become popular amongst the corporate investors going forward. What about the caps of funds exposure to?
That is also a de-risking thing, that the cap being reduced from 25 to 20%. But I think that is something which fund managers should exercise that diligence anyway. Okay. It is not about the sectoral cap or a 5% exposure, maximum exposure to a group. That is something which most fund managers should take care of it anyway, because that is in their interest, that is in the interest of investors, and that is something which will actually not give them nasty surprise.
Okay, and even the redemption within 7 days doesn't seem to be too harsh. If it makes things better, then I think the 7 days is good enough.
The investors who come into liquid fund, if you have to see that what they are expecting substantially.
The nomenclature is
the nomenclature, that liquid and it will not go down. That is the implicit, however you may say that mutual funds are subject to market risk. Investors don't expect that they are subject to market risk and they need to experience it every time, and definitely not in liquid fund. So it is aligning with the general expectation despite the disclaimer. So liquid funds will become safer. They will yield lower return. They will be, you are unlikely to get surprise, and it will attract the right kind of investors, and it will not be vulnerable to any kind of crisis there could be vulnerability at any point, but it's unlikely to give, if you invest for 7 days and more, liquid funds will remain reasonably attractive. And then, you have many other categories beyond this. Ultra short-term bond fund, which will actually have all the traits of, what liquid fund is today.
Okay. Safer seems much better than getting...
Yes. If we have to, weigh between the two things, that greater safety and small likelihood of getting a bad surprise, I would go for greater safety.
So what will be the impact of these changes that we just discussed on the investors?
Two things. Liquid funds will become a little more volatile, which will not be, to investors' liking, but that's fine. If you invest for 7 days, you will end up having more return. If you are investing for less than 7 days, the way around is go to the overnight fund. And the other is liquid fund return will come down a little bit, because if they are going to be forced to invest 20% in cash and cash equivalent, that part of 1/5 of the portfolio will yield lower return, marginally lower return. So these are two key impact, and the trade-off is that liquid funds become far more safe
and reliable for investors. What about the NAV of these funds? Will they in any way reflect a true picture?
Yes, because the whole portfolio will be mark to market, so they will go up and down a little bit much more. Earlier the rule was, or the understanding was, the implicit understanding or the experience has been, except on 2 occasions in the last 15 years when it went down by few paisa in a day, but except on those 2 special occasions in the last 15 years, liquid funds NAV always went up or remained where they were. It never went down. So there is a possibility that it will become a little more volatile. Maybe on some occasion it will go down by a paisa or so, but that's about it.
Okay. So what about the investors getting more diversified and better quality portfolios? Would you like to elaborate on that part?
Liquid fund is a very tiny part when it comes to from an individual perspective. Liquid funds were reasonably safe. These things are not actually addressing the real problem of the debt funds in general. These are basically preemptive measures to ensure that SEBI has been worried about the state of liquid fund, the scale of liquid fund, and any problem there, which can snowball into a very big financial crisis. And increasingly, it is being used as the bank account for the companies. The wallet of the corporate sector. So making it robust, making it safer, making it that has been the focus. Diversification, greater liquidity, more aligned, truer picture with mark to market. I think these are all steps. 9 steps being taken to ensure that liquid funds become safer, transparent, clearer, and right kind of investors come with the right expectation in such funds.
So who should not be coming to the liquid funds now?
No, if you are investing for few days.
So liquid funds are safe and reliable?
No, this is also safe. Just that, we have to see that what kind of exit load will be clamped. Will it actually amount to 0 return for you if you just in case take your money out within 7 days? It looks like it will be, it will become, and this will benefit other investors. So in that sense, money for more than 7 days, liquid fund remains as attractive, in fact, becomes more attractive because it is safer.
Okay, I think I've got the answer that I was looking for. However, to make it very, our viewer friendly, let me just rephrase this and ask your opinion as to how do you see these changes? Is it good for an investor or is it bad for the investor? Simply put.
Great for the investor. Liquid funds are safer, and that is what you primarily expect.
All right. So it's great for you, liquid funds, and with the new norms that SEBI has come up with, it's good to invest in them because your money is going to be safe and reliable for you as an investor.